What if I told you that this 5% drop on your portfolio in Nairobi Security Exchange is actually the best financial news that you're going to hear today and going forward? Well, other investors are panicking. You can see a lot in the social media that NSE is going to crash. The smartest investors in NSE are quietly celebrating. A 5% drop, like for this follow of mine, or even 30% drop in your portfolio, is not a crisis. Otherwise, it's a flash sale or a discount to buy NSE most valuable companies or counters at a discount. And some of these counters are like BAT, Equity. If BAT today goes to 200, why would I not buy even though I had bought it at 520 or 570? Equity Bank, if it goes to 30, I'll accumulate more. This, in other words, this is not the time to do panic selling or to get stressed. No, this is the time to celebrate, because it's the time to get those good companies at a discount. And by the way, this is just a 5% loss. Very minimal. Don't even look at the figure of 22. Look at the percentage. 5% loss. Those ones I call normal price corrections in Nairobi Security Exchange. So what are you supposed to do as a smart investor? You are supposed to employ a weapon called averaging down. And this is what I'm going to advise everybody, because now it's assumed, going forward, the market might start going down, especially if inflation, nasai with the fuel price being up, inflation ndio hiyo, central bank start increasing the interest rate, then the body would become very attractive. People move their money from the Nairobi Security Exchange to the bots. Before you know it, the market start going down. So what do? You celebrate as a NSE investor, because you are going to get these good companies at a discount. Pullbacks are completely normal in NSE, and we call them price collection. And markets, they do not move in a straight line. Pullbacks happen, especially when those institutional and foreign investors, they take profits by selling their stake. Because institutional and foreign investors, they are not there to for dividends. Them, they buy low and sell high to make profit for the people who have invested in them. But this is not the time to get stressed or to panic sell, because the moment you do panic selling, you realize the exact loss. Like this, if he's to sell his shares now, he will realize the exact loss of 22,000. But that is just a paper loss. So what do? You look at the bigger picture or the broader picture. Because NSE top companies, or those I call strong fundamental companies, they are very strong. They own the biggest networks. They serve large number of customers in the country. They make a lot of solid profits and revenues every single year. We have seen those figures every now and then. Equity, Safaricom, BAT. And when a strong and a well-known company stock, it's deep, and its business, day-to-day business, does not change, what does that one tell you? The fundamentals are still strong. A case example, M-Pesa does not stop processing transaction even though Safaricom share is going down. Or big banks like Equity and KCB, they don't stop lending even though its share price is going down. So the fundamentals are still strong. And in fact, when you buy these stocks at that cheaper price, if you are to buy Equity today at 30 bob, if it goes down, or KCB at 40 bob, BAT at 350, do you know what you are gaining as a dividend investor? You benefit from a higher dividend yield, because you are getting the exact same share of the company profits, but at a cheaper price. So look at the bigger picture. So how do you handle this as a professional or a smart investor? you employ the strategy called averaging down. Hiyo nimeiongelea sana kwa most of my videos. Some of you are practicing and some of you are they have embraced fear as one of the enemy of Nairobi Security Exchange. So it means you buy more shares of a stock as its price falls, and by doing this you lower the average cost you paid for your total share. And when the market rebound, and history shows that fundamentally strong companies always do, they rebound, your portfolio returns to profitability much faster because your entry price now is lower because of averaging down. But what I'll tell you here, don't gamble by trying to guess the absolute bottom of the market. Saa hii hatujui, we are going to election here, ndio hiyo inflation. Hatujui even on 9th when the central bank leads its monetary policy statement and they increase the base lending rate. If they increase, the bond market will become attractive and NSE unattractive, so the NSE will go down. So use the dollar cost averaging, where if you have like 100K and you need to invest, divide it into equal amounts. As it's going down, continue buying. You buy in phases. You don't go all in at once. If it continues going down more and more, put more money. But if you are still anxious and still have that fear that NSE is going down, first thing I would advise you, diversify your risk. And how do you do it? If the bond market become attractive, it's high time to buy a bond, because a bond, it's more of safe or it's lower risk, and then it has guaranteed return. So diversify. In conclusion, market dips reveal the difference between speculators who trade on fear and investors who build generation wealth. Choose, are you a speculator or you a smart investor? Thank you.